I kind of think that we need to be careful because of this month-end rebalance, right? We were told it was going to be huge. I had technical signals that said the market could bounce on a shorter-term basis, like daily stuff. My weekly stuff still says there's more downside. So I'm not sure whether this becomes the false hope or it feeds on itself. I mean, who the hell knows? But there's a massive rebalance going on, which is why it's all squeezing. It's a long weekend in the US, so everyone had to jam the order book in today. So the question is does it sell off after Memorial Day? Does it continue to go for a bit and then sell off, or was that the low? It feels that I've looked at past episodes of all of this. You know, when the Fed are pivoting or the economy's weakening, bond yields tend to come down further before that happens because we've only just really pivoted. Sure, break-evens have come down quite a lot, but bond yields themselves have only just started. So I feel like it's too early to have the kind of celebration of the Fed are going to pivot and everything else.
Welcome back to my channel. So Bitcoin closed May, a historically strong month, in the red after rising above 30,000 for a short period. According to Raoul Pal, it's too early for the celebration. And you will totally agree with him. I mean, we all saw a relief rally for Bitcoin this past Monday, when Bitcoin finally rose above 30,000, and markets responded to the relaxation of COVID-19 restrictions in China and the faint possibility that the US central bank might relax its monetary hawkishness much later this year. But all this good faith faded into the mists, as we witnessed Bitcoin to again trade below $30,000 on the first day of June. Ethereum also fell down by approximately 7% over the same period. Similarly, altcoins also started with the red. In today's video, I'm going to share Raoul Pal's view of points towards the ongoing market and why he thinks inflation could go negative. If you're new to my channel, be sure to subscribe and hit that bell icon. So now, let's dive into the video.
I think the inflation peak is in. Just the year-on-year comps, let alone structural inflation, I think the year-on-year comps are going to be, we'll see inflation come down pretty sharply. Now, I also think there's massive demand destruction going on in the economy too. When I look at monetary conditions, not just using the Goldman Sachs index, but if I add in, so if I use it, the rate of change of mortgages, 2-year rates, oil, gasoline, and the dollar, that's the largest monetary tightening in all recorded history that's underway. And I put a piece out on Real Vision today that should come out shortly about some of this stuff. And I think we have the potential to set up to see negative inflation next year. I think the one thing that needs to happen for that to occur is for crude oil to fall. It doesn't have to fall a lot, but then the year-on-year comps by March of next year, crude oil is going to be a massive negative year-on-year. So, and that's not going against the crude oil story, which is the structural supply issue. It only has to trade lower for a period of time down to $70, $80. And before you know it, the inflation number absolutely collapses.
Raoul Pal believes that inflation will come down pretty sharply, but why does he believe so? Will the Fed pivot this year or not? Now, that's $1 million question. Before going there, Raoul shares about his killer chart that shows him everything going on in the market. Are you curious? Me too. So let's hear him out.
Yeah. Global Macro Investor Roundtable. Julian Bittle put it together for me. It was like the killer chart of the entire event. Everyone stopped in their tracks. I mean, I've got a lot of charts that look like this, but this made total sense because I've been saying that the increasing fixed costs, commodity prices, PPI, all of that stuff was going to destroy consumption, demand destruction. The dollar was always a problem because it went up quite fast at a rapid rate of change. And rates have gone up, 2-year rates and 1-year rates have gone up at the fastest rate of change in all of history. 1-year rates in the US have gone up 800%. And wow. People say, well, that doesn't matter because the rates are low. I was speaking to a good friend of mine last night, big family office, multi-billion-dollar family office. And he's like, oh, yeah, we refinanced everything. And I'm seeing it with all my friends. Everybody who's refinanced their stuff is now seeing massive interest payment increases.
Dollar really fastened up his seatbelt and went on for a Ferrari ride. I mean, both the 2-year and 1-year rate have witnessed the fastest rate of change in all of history. 800% on a 1-year rate is no joke. Now let's hear out why Raoul Pal believes the inflation could go negative.
Simply, the year-on-year comparisons of these commodity prices are a really hard comp, right? So oil at 100, wherever it peaked out at $120, right?
Yeah.
Anything that's not above $120 is going to give you negative year-on-year rate of change of oil.
Yes.
In a year's time. And that happens on everything from food prices, which are still going up, to pretty much every single commodity. So you're going to get some really astonishing comps. Now, it's not real inflation. It's not like the price of goods is coming down. It's not deflation, but it's a very different setup than the market currently accepts. And the last time we saw something very similar, again, sorry to bore people with history, was 1947 to 1949. We came out of World War II.
You're digging deep. You're really digging deep on that. 1947.
So why it's similar is supply issues. Everybody comes back into the workforce and back into normal life, right? Prices explode, obviously. Demand, restricted supply.
Yeah.
So we got 13% inflation. What happened a year and a half later? Negative inflation.
He thinks the situation is very similar to what happened back in 1947 to 49. There's a massive demand destruction going on in the market. So, will the bonds follow it too? Before heading to the video, be sure to like and share.
I map out a ton of these relationships. Equities, copper, inventories to sales, a lot of the forward-looking stuff, all is recession. Some of them are severe recession. Anything that has monetary conditions in, PPI inverted versus ISM, it lags. That's putting the ISM at 30. So it feels that most of the risk assets have priced it. There are two that haven't, pretty much only two. One is oil and one is bond market.
Yeah.
So the bond market has been following basically oil's rate of change more than it has anything else. And I can understand that because of the inflation fixation. But I think that evaporates. And we've seen a very similar setup. I've done a lot of historical analysis of these, what causes the Fed to change path. So I started with 1974.
Yeah.
1974 was very similar to now. We had a supply issue in oil, which was the Arab oil embargo. We had prices rise, CPI was rising, the Fed were hiking, the dollar was rallying, and then growth collapsed. And the ISM went from 56 to 30 in 4 months. That's what I'm getting in my data to suggest is possible. The next one was 84, and the Fed cut in the middle of that with inflation still up. They cut as soon as the ISM touched 50. Same in 1984. Same in the 2000s, same in 2001, same in 2018. So I think the key thing is here is if the ISM comes below 50, they start to worry about the jobs mandate. And we're already hearing the tech companies saying we're going to lay off people. Amazon said they were wildly overstaffed. So the last shoe to drop, it happened in 2018, 2001, and I think it was, obviously in 1974 was the last shoe to drop was the oil market.
So the question arises in my mind whether the Fed will be more hesitant in pivoting due to the fact that we're still running above the inflation target. Let's see what Raoul has to say on this.
This came up at the round table. There's a narrative which is, well, if inflation's still high, we need to see it coming down to 3% or whatever before they do anything. So I went back and checked every time in history. That never happens. In 2001, they were cutting all the way through from oil going from $100 to $140. 2018, they were cutting. They paused and had cut with the oil price coming up. Most of these examples, when you go back, even in the 1970s, inflation was still going up and oil was still going up while they were cutting. And in 1974, they were cutting from about July, and really inflation didn't roll over till early the next year. So I think it's a red herring. I think they will focus on inflation, but they realize that demand is the bigger driver. And as soon as demand starts to showing that it's coming down, i.e. the economy starts shrinking or heading that way, that's when they pivot. And that was 2018 in a nutshell. ISM touched 50 and they stopped.
As per the historical data, inflation didn't stop going up even after Fed tightening and cutting down. So according to him, this never happens. It's a red herring. The Fed focuses on inflation when the bigger driver is the demand.
If we end up in this situation where inflation doesn't come down, I actually think it goes negative. But if it doesn't come down, then we've got a longer term issue that could be more of a bone crunching bear market.
Inflation really needs to come down for the market to run calmly again. So what are your thoughts on this? Do you think the Fed will pivot this year? Or do you agree with Raoul that inflation could go negative soon? Let me know it all in the comments down below. And be sure to subscribe to my channel for more interesting videos like this. I'll see you in my next video.